Alrighty. So in this video, I'm going to be sharing with you the ultimate credit spread income strategy. So basically, I'm going to share with you step by step how you can look for this credit spread setups. And this is very good for you, especially if you have a small trading account size that is anything that is under $25,000. So I'm going to share with you what I look out for in the markets and what I see on the charts before I put on the credit spread. So this is the credit spread trade setup. Now there are two different spreads. As we already know, there's the bull put spread, which is the short put spread, and then there's the bear call spread, which is also known as the short call spread. Now I've already created an in-depth video on both of them, on also the trade mechanism and how you manage them. So if you haven't watched the video yet, just go ahead and watch the video first. I'll put the link at the top right hand corner of this video. But for this video, I'm going to share with you the step-by-step way on how I look for this trade setups. Right, so let's start off with the bull put spread trade setup. So first of all, step number one, what you want to look out for is for the stochastic oscillator to show an oversold reading, because this is a bullish trade. So as much as possible, we want to put the odds in our favor, right? So if you want to enter into a trade that you're hoping the trade would go up, well, it's much better for you to look for an oversold reading rather than when it is overbought, right? You want to put on a bullish trade setup when it's oversold rather when it's overbought. This way, it will have a higher probability, a higher chance for it to go back up once you put on the trade. All right, step number two is you want to identify the nearest support level or the previous low. I'm going to share with you also this once we get into the trading platform later on. I'm going to show you on the chart how I identify this support levels as well as the previous low. Now, step number three, you want to identify your short put strike level. And ideally, you want these to be at or below the support level or the previous low. And then step number four, you want to go to the option chain to see if the short put strike level is within 20 to 30 delta. So that is the criteria that I kind of look out for, because I want to sell the put spread that is out of the money. All right. Again, I've shared this in another video, so you can go ahead and watch that video first. Now, step number five, you want to then construct your bull put spread and then see if you at least get $1 to $1.50 in credit. And for this, we are basically looking at a $5 spread. So for example, if your short put is at $100, then you're going to have the long leg of the put spread at $5 away, so that will be $95. So this way we are looking at around $1 to $1.50 in credit, and then you're looking at somewhere at a max loss of about $3.50 to $4. All right. Then finally, you want to place a limit order at your desired credit level. Again, I'm going to show you how that's done later on. Next, we have the bear call spread trade setup. So this is pretty much just the opposite of the bull put spread. So step number one, we want to look for the stochastic oscillator to show an overbought reading, because now this time we are bearish. We want the market to go down. So it would be better to enter a bearish trade when the stochastic oscillator is overbought rather than when it's oversold, right? Now, step number two, we want to identify the nearest resistance level or the previous high. And then step number three, we want to identify the short call strike level. And ideally, we want this to be at or above the resistance level or the previous high. And then we want to go to the option chain to see if the short put strike level is, this is the short call strike level. We want to see whether the short call strike level is within 20 to 30 delta. Right, so step number five, construct your bear call spread and see if you at least get $1 to $1.50 in credit. Again, this is a $5 spread, vertical spread. And then step number six, we place a limit order at your desired credit level. All right, so we will head on over to the trading platform so you can take a look at what I'm talking about, how to put these steps into action. Okay, so this is my trading platform. This is TD Ameritrade, otherwise known as Think or Swim. So the first thing you want to do when you open up your trading platform is to go through your watch list, right? So you should have created a watch list of all the potential stocks and ETFs that you want to trade the credit spreads on. So basically, what I look out for when I form this watch list is for stocks and ETFs to be around the range of around $100 to $500, right? It's pretty good for the vertical spreads or these credit spreads which are trading, because we're going for roughly a $5 to $10 wide spread, right? If you have a small account, generally you want to always go for a $5 wide credit spread, a vertical spread. Right, so $100 to $500 would be pretty good. And the next thing I like to look out for is for the liquid stocks. Right, you know whether a stock is liquid or not by simply looking at the option chain. Right, if you were to take a look at the option chain, you will kind of see that the liquid ones tend to have all these weekly options. Right, if there's no weekly options, generally it's not as liquid. So the next thing you also want to look at is also how, how wide is the bid and ask spread, right? So if you were to take a look at the inside bid and ask around here, you can see that this market is decently wide. It's still considered wide, right? But because this is an index ETF, I kind of still be more inclined to trade it. But basically, this is how you tell whether a stock is liquid or not. You want to avoid those stocks where, the bid ask spread is really, really very wide. All right, so the first thing I will do when I pull up the stock is basically I'll look at the charts. Now, you could have stocks or you can have index ETFs to trade the credit spreads. I generally prefer to trade the index ETFs because you do not have to worry about earnings and also unsystematic risk, right? Unsystematic risk is basically when the company releases news that is very specific to the company itself. It doesn't affect any other companies. It just affects the company in question itself. Like, for example, if a company gets sued, all of a sudden, then chances are the market is going to gap down, right? It's going to crash. Or let's say, for example, if the products were recalled in the market for some reason, or some of the products was not working well, then this will have a very negative effect on the stock, right? Most of the time, this is considered negative news and the stock will kind of just gap down. So this happens with individual stocks more often, and it doesn't really happen with index ETFs because they are a basket of stocks. So when it comes to credit spread, my first preference will always to be trade the index ETFs over the stocks. But having said that, I would still find some individual stock trades if I can't find trades on the index ETFs. All right, so what I'll do, first thing I'll do is just pull up the charts like this, and then what we want to see is whether the indicator, right, this is a stochastic oscillator, whether it's overbought or oversold, just basically like this, right? So that's the first criteria. So I have the weekly chart on the left hand side, I have the daily chart on the right hand side. You do not need the weekly if you don't want to. It just gives me the overview of what the stock has been doing. But basically all I'm looking at is the daily chart, right? So daily chart, the indicator is what I'm looking at. Now I just take a look at to see very quickly a glance, is it overbought or is it oversold? If it's not overbought or oversold, I move on to the next stock, right? I shift on to the next stock. So as you can see, for this is XOP. It's also an index ETF. Now for this, you can see that the market is almost oversold, but it's not oversold yet. So what I'm looking out for is for this to go below here, and then I will start to look for trades. Now, I do not necessarily will place a trade, right, even though if it's oversold, because the other criteria which I want to look out for is to see whether the strike I want to choose is at or below a previous support, right? So this is for the short put spread, the bull put spread. So let's say, for example, this is right now oversold. Let's say this is oversold, right? And I might be looking to place a trade. But if you were to take a look at the chart, where would be the previous low or the previous support level? It would be at this 115, right? So I would only be looking to place a short put spread if I can get the short put strike at 115 or below. Now, if I were to pull up the option chain, you would take a look that it would actually be very difficult for us to construct a bull put spread because of it's very far out of the money, 115, right? So regarding the expiration, the days to expiration, you go anywhere from 30 to 60, right? So this is somewhere in between, 44 days. Now, some people have ever asked me before as well, should you go for the weekly or should you go for the monthly? I think they're both fine. You just want to choose one that's of your preference. The weeklies tend to be less liquid in the sense whereby the bid and ask spread is not as tight as the monthly. So if you were to take a look at this, you can see the inside spread is about 15 cents for the put side on 137. But if I were to take a look at the weeklies for this, you can see it's slightly wider. This is 25 cents, but it's not that big of a difference as well. So really it's up to you, right? So I prefer to go somewhere around the 44 days. So if you would go for this, remember, if we take a look at the chart, you can see that we want to go for 115. So what I'll do is I'll take a look at 115, and I want to see, is this around 20 to 30 deltas? If it's not 20 to 30 deltas, it's less than that, you know for sure that you're not going to get the credit you want, because the credit which we are looking for is around $1 to $1.50. So you can see very quickly the delta here is 15. So chances are it's not going to hit our criteria. Well, we can just take a look. What we're going to do is we're going to do a vertical. So we take 115, and then we go to the long put side will be 110. So you can see this 5-point spread. So you can see it's only a 66 cents credit, which is much lesser than what we want. So chances are that we will not take this trade, even though if it is oversold. So instead, what I'll do is I will wait for it to continue going down, and if it does go further down and I'm able to get the credit of $1 to $1.50, then I would go ahead to place the trade. But as of this moment, it's still far from our criteria, right? As we always know, oversold can always become even more oversold, overbought can always become even more overbought. So it doesn't mean that the market, the moment it goes past this line down here where it's oversold, doesn't mean that it will snap back up immediately, right? There's a chance it can still continue down and start to even test this, right? So that's what I'm looking for. I'm looking for the market to really go lower until I can get this credit up to about $1.50 before I'm going to place a trade. So if this is so I'll take a look at this and see that there's no trade. I'll move on to the next stock again. So I'll take a look at to see whether it's overbought, oversold. So for this, I've actually have a trade on. As you can see, the market has really been stretching all this while, right? It's really overstretched and it's severely overbought. So that is why I place a short call spread down here at 155. And the thing is that you notice that the market is already overbought at this point, 135. But I didn't place a short call spread down here because the target which I'm looking at to place would be 150 and above, right? Because the previous high would be at this point, right? This is the previous resistance level. So I'm only looking to place a resistance here. So when I saw this, it was overbought. I didn't place any trade. I didn't think that this would pass through because it was still far away. Then as it got closer and closer as the market went up, I managed to place a short call spread. The moment it was able to get me a good credit. I think for this I roughly got about $1.20 for this 155.160 credit spread. So I've got it on right now. So at the moment, we still have some time to go to see whether is it going to go back down, right, or is it going to continue to go back up. So what you want to do is to manage it according to the 4 different management styles I shared with you in the previous video. Again, you want to go back to watch the video. If you haven't watched that, I share with you the 4 different management ways. But basically what I do is that I will take profit at 50% of the credit I receive. If I don't get that, I will wait until it's 21 days to see whether the short put strike has been breached. If it has breached the short put strike and it's less than 21 days, I'll just take a loss, right? I'm not going to wait until a full loss before I get out, right? And if it's past the 21 days and it's still below the short strike, then I'm just going to hold on to it because there is always a chance that it will still expire out of the money, right? It doesn't breach 155 by expiration. So that is something that you want to decide for yourself, the 4 management style. Just go ahead and watch the previous video if you're not sure what I'm talking about. All right, so same thing. I'm going to go to see all the different stocks again. All right. So I want to see whether is it overbought. So this is a little bit, all right. So we're getting to a point where it's a little bit overbought, but we know that the previous resistance is somewhere here, right? So it's around 191, 192. So what I'm looking to go short at, the short put strike, is I want to go at $200. As you can see, there's another point down here where there's a previous resistance, previous high. So $200 will be what I'm looking at. So as you can see right now, it's still pretty far away from our criteria to get 200, right? So again, go to the option chain. All right, go to the option chain and then take a look at the 200 strike. So again, I'm looking for here. So I'm looking for the call side. The call side for 200 is somewhere here. So as you can see, the delta is 12. So there's no real point for us to construct this bear call spread because chances are we are not even going to get a credit, right? So if you could see that the difference between these 2 points is only about what, 36 cents. That's just not going to cut it, right? It's not going to cut it. So we just just leave this. We keep this in mind. So in case if in the next few days, next week, the market continues to go higher and it's still overbought, then yes, then we can go ahead to place our trade somewhere at $200. So basically that's it, right? So I'll just go past all the different stocks, right? If it's not overbought, do nothing about it. Not oversold, do nothing about it. This one, pretty close, not even overbought yet, I'll do nothing about it. So this is basically what I do, what you will do every single day, right? So again, this is another trade that I've already placed. You can see I placed at this point when it is overbought, All right, I waited until I could get enough credit to short the 245, right? So I went 245, short down here. So far it's doing pretty well. All right, we'll have to see whether the market is going to shoot up or go back down. All right, so basically this is pretty much it. As you can see, I placed quite a number of trades. So sometimes you will notice that, you know, when the market is overbought, a lot of the stocks in the same sectors will tend to be overbought as well. So this is a decision where you want to make. Do you want to go short? You know, do you want to do a call spread on all the related stocks, or do you want to choose only one of them and then you want to go for another different type of stock, right? So this is a call you want to make, and you also want to position size it based on your account size as well. So if your account size can only trade, let's say at most 3 to 5 positions, then you want to find the 3 to 5 best setups that you can find, right? So generally the best setups are when all the conditions meet, right? The conditions meet is when it's either overbought, oversold, and the strike price you can get is above the previous resistance or support level, and you can get the credit which you want. All right, guys, so this is pretty much how you can go ahead to place a credit spreads for yourself in your own account. So go ahead, take it and use it and apply it. You can also change it to your own style as well. Nothing is fixed in stone. Alright, so that's it for this video. I hope you find this video useful and helpful. If you have, please give me a thumbs up and also subscribe to my channel so I can create more videos for you. And as always, thank you for watching. I appreciate your time and may the options favor you.